we have to become aware of the fact that this technocratic shield that they've built up around them has stopped us from having a real debate on the way that central banks are currently keeping capitalism running.
Welcome to the New Enlightenment podcast from Adam Smith's Panmure House. I'm your host, Adam Dixon. Today I'm joined by Matthias Thiemann. Matthias is professor for European public policy at Sciences Po in Paris. His work focuses on financial regulation and central banking, looking specifically at post-crisis regulatory changes and the changing role of central banks in capitalist market economies. Today, Matthias and I will discuss, among other topics, his recent book published by Cambridge University Press, Taming the Cycles of Finance, Central Banks and the Macroprudential Shift in Financial Regulation. Matthias, welcome to the New Enlightenment podcast.
Thank you, Adam. Thank you for having me. It's great.
Right.
To be here.
So let's talk about central banking. But you have to do it in an exciting manner. I think probably half of the people that started listening heard central banking and they just said, stop. And they gone on to some other particular topic. So tell us a bit about what's going on or what's been going on in central banking that the regular person on the street should care about and why.
Yeah, absolutely. So central banks from the 1980s onwards are I think the central institution that drives capitalism much more than ministries of finance. So since you may know that they are independent, so all of them can have a large degree of freedom, but what they're really doing is they're setting the interest rates that drive so much of our economic life. And before 1980, there was much more of a direct control by governments over it. So the Ministry of Finance would give a call and say, hey, the interest rate is too high or whatever. And in particular, since the 1980s, central banks insist on their independence. But doing so, you could argue they've been responsible for many things. I think most importantly, for the rise of, at least for the rise of inequality. Mm-hmm. I mean, we've all heard of the quantitative easing programs, the thousands of billions of dollars that they've brought up in financial markets, and that had a particular effect on wealth inequality, supporting the assets that the rich mostly hold. And I hope we get into this because yes. I think that's why people should really care about central banks. They're really huge centers of power that, at least currently, are not very much under political control.
So does that mean then that they should be under more political control, right? So tell us that, I guess the question then is, because on the one hand, central bank independence in principle is a good thing, correct? And political control, I'm just thinking of someone that's a proponent of independence will say, well, look at Argentina or look at, emerging market and say they're politicized, they're under political control, and it's been a disaster.
Yeah.
So tell us a bit about give the pro-independence side, give what's wrong with that.
Yes, very, very much so. So the pro-independence side is that if you have politicians meddling, of course, right, they want low interest rates before an election and so on. And so then the central bankers might not end up doing what they should do. And the big example of this is the way that Nixon interacted with Arthur Burns in the 1970s and called him up and told him, hey, you got to lower these interest rates. I want to get reelected. And many people see in this a reason for the inflation of the 1970s, that then Volcker came in and really brutally raised interest rates to end inflation. Now, there is a good argument for that, but what I'm trying to show in the book is that there are also other arguments. In particular, we often think about the relationship between central banks and politics, but we also have to think about the relationship between central banks and financial markets. And what I'm showing in the book is that we could say so in the literature, often people talk about fiscal dominance and they say, hey, the central bank can't do what they want because the government is forcing them and the debt has become so big. I think we're really living in an era of financial dominance. That is to say, whenever something goes wrong in financial markets, central banks step in and backstop the financial markets. And that has big distributive implications because it always supports it. You can see this very nicely after the financial crisis, right? So you have the financial crisis, the stock market tanks, and everybody's like, ah, so many people lose their job, many people lose their houses. And then what happens? QE happens, which means that the stock market goes back up, and then the rich get a lot richer. And then this idea is this trickle down economics of like, if people feel richer, then they will spend again. And that's how they revived the economy in the US. Okay.
Yeah.
And that's a way of reviving it. But I think what is interesting about it is that this technocratic shield, these central banks are like, we are the technocrats. We know what we're doing. And then they will always have this beautiful way of interacting with the public on this. After they were pressured, actually, people said, hey, there's a problem. And then they said, yes, but if we hadn't done anything, it would have been much worse. And this is really their way of defending what they're doing. And I think, we can argue about this, but what's the counterfactual, right? If they had done nothing, yes, we would have been in a huge rut and a huge problem. But I think there's something underlying here, which is like, we have to ask the question, why are they so vulnerable? Why can they be taken so easily hostage by these financial markets? So that when they tank, they have to go in big time, and bail out these actors and like push the stock market up again. And then, we have to have a discussion about this. I think that's what we really have to have. Before we say, oh, they should be independent or they should not be independent, we have to become aware of the fact that this technocratic shield that they've built up around them has stopped us from having a real debate on the way that central banks are currently keeping capitalism running. I think that's the important discussion.
But a particular form of capitalism that is less willing to embrace a market liberal approach, in the sense that when you look at central banks and what they have done under QE, or what they did under QE, you had arguments on, and again, it's hard to put these on a particular spectrum, but then you had the classical liberal argument saying that they're bailing out failed capitalists, and this isn't right, and this is distortive, and in a way they're not politicized, but their technocracy is a form of politics. And then you have those that are, and I would say that, it's not to say that classical liberals aren't concerned with wealth inequality. I think there's sometimes an assumption that they're not, but I don't think that's true. But then you have, let's say, on the more left, those that are say like, look, this is not okay, because it just reinforces, particular class structures and bails out the rich over, bails out Wall Street and not Main Street, right? So that's what I think is quite interesting. And it's always trying to figure out, because on the one hand, you look at debates around independence, and it's kind of portrayed as, oh, it's just a form of neoliberalism. But actually, often you look at it and think it has nothing to do with liberalism in the classical sense of let markets kind of do their thing. It's a much more managed for a particular class of people, of market actors. And that's where the politics of it is quite interesting. So tell me though, then what's transpired? I mean, give a bit more specific kind of history so from the 1980s onward, we know we had more independence. For a couple of decades, that was not problematic. I mean, inflation was kind of, maybe, I don't want to say it was unproblematic, but, inflation came down. Inflation wasn't a problem. I think a lot of financial actors forgot about inflation as a thing, particularly at least in Western markets. In Europe, the ECB tamped down on inflation in Southern Europe and other economies through the introduction of the euro, which was a good thing. But then you have, 2001 come in, and things start to change. Greenspan starts to do a bit more. And then obviously during the global financial crisis, that sort of steroids were injected, right?
So this is where my book tries to intervene, actually, and it tries what it tries to show is that these central bankers from the 1980s, they're having this discussion where they say, hey, so the capital markets and the banks, they grow ever closer together. And they're a bit scared about this, right? They look at them. There's a faction of central banks very scared about this. They're like,
Right.
we'll have to backstop this. And so in this context, they're saying, well, it would be nice if we could actually intervene and structure this relationship between the capital markets and the banks, so the shadow banking, you know, what people call shadow banking, in a way that we have some degree of control over it. And what I'm trying to show in the book is essentially that these voices, they were kept down, you know, by other factions that said, no, it's all good, everything will work out, don't worry, and so on. And in the end, they always had to step in and bail it out. So this is 2001. You mentioned 2001.
Yeah.
That's the dot-com bubble. That goes, the stock market goes like this, and then it goes down, and Greenspan intervenes massively. That's from that time we have the Greenspan put. What I show in the book is that actually in 1995, Greenspan gives a remarkable speech in New York at a conference on systemic risk. And so I look into how these central bankers look at systemic risk, which is this risk of the entire system, you know, exploding. And he says there is this trade-off. We want markets to take risk, and so we want a certain degree of systemic risk, but we want a certain degree of like control. And what I'm trying to show is actually that as they're pushing for control, they never get it. And that's what I call in the book the unhappy consciousness of central bankers. Because they're looking at the system and they're saying, oh, it gets ever more interwoven, it gets ever more dangerous. And when something bad happens, we'll have to intervene. But whenever they try to convince anybody else, everybody else says, shut up. So the securities market regulators say, we don't care about systemic risk, we care about investor protection. Right? The House in the US says, what are you talking about? We just want growth, and growth comes with rising stock markets and rising mortgage. Like, they love it. So everybody loves it. And until 2007, 2008, you know, you have these like little guys in the corner that say me, and you know, they have the East Asian financial crisis, and so they have these moments when they say, look, it's happening. But everybody else is like, but it's not happening in the West, you know, it's the Asians and so on, you know, the crony capitalism, and it will never happen in the US because we have these developed financial markets and so on. And so this is the situation until 2008. So I'm trying to trace this. And then 2007, things start to go, everybody, many people know, right, that things started to go a little bit awry in 2006. And people are like, what's going on? What's going to happen?
Bank failures in Germany, or the that sort of kicked off things, and it's like, what are these kind of like small state kind of backed banks in Germany investing in these really exotic financial products? And you think, oh, wait a minute. And then it turned out that was the entire investment thesis that everyone was doing. But before you go into the global financial crisis, I think it's important for listeners to understand. I mean, so I think systemic risk is a concept that's pretty easy to understand in the sense that it's, well, I guess it depends what you mean by systemic risk, because right, your book kind of sort of looks at all these debates about what do we mean by systemic risk. But in general, like, it's the risk of the system collapsing. Let's take it at that, and we can look at that. But when you talk about capital markets versus the banking system, you mentioned shadow banking. And I think for some that might be, well, what do you mean by shadow banking? What do you mean by capital markets and the separation for banks? Like, what was the, you know, pre-1990s view of central banking? And, you know, we think of banks, and you go to the bank, you put your money in, there's deposit protection schemes from after the Great Depression. That's where you get your loans, you get your mortgages. And what's then the difference between that and capital markets? And then how does that complicate central banking and the function of a central bank in the economy?
Yes. And this is a very good question, because it's exactly this dilemma that will travel from the US to all Western economies. So what's happening is that from the 1950s and 60s, as Americans get richer, they start to put their money into pension funds.
Mm-hmm.
And I think you had Brett Christophers on or something.
Yeah, Brett
Yeah.
Christophers was on
So
the
he
second.
wrote all this and so on. But
Yes.
you see how as the Americans put their money into pension funds, suddenly the banks in the US have a competitor, and the
Mm-hmm.
companies, instead of refinancing with the banks, they refinance with the pension funds. So the banks are looking at this and they're like, oh, we have a problem. Like, and then they do something that is a famous quip, right? If you can't beat them, join them.
Right.
And so in that moment, they start to become, I don't want to call them the servants of these pension funds, but they start to become like, they talk to them. What do you need? How can we help you? And so on. And then in this context, a lot of new actors emerge that will provide mortgages and other kind of things to Americans that are not necessarily exactly banks.
Right.
And so the banks start to say, okay, don't you need some liquidity, or can I backstop you, or how can I interact with you? And so this is where this moment of interaction and interwovenness comes in. And the central banks are looking at this, and the central banks start to realize that they're in a sense losing control. Right? They're losing control because on all kind of levers that they had, these banks start to behave differently. So instead of getting deposits from savers, now they go to the capital markets and they get the liquidity from the. How do you regulate that as a central bank, right? And now they give backstops to shadow banks, so these actors that extend mortgages. How do you regulate that as a central bank? And so there's basically the growing complexity of the financial system, and these guys are saying that's a problem. The central bankers are saying that's a problem. We should look into that. But they would need to build an alliance, right, with all these other actors to acknowledge the fact that the world is different. And everybody else keeps saying, no, it's fine. Everything works. What's your problem? Right? Always, when the sun is shining, you don't like people telling you that there's a storm coming up, right? You're like, no, what are you talking about? It's beautiful. And so everybody kept doing this, extend and pretend, no, but everybody kept, doing this. Oh, things are fine. What's your problem? Things will not be that big. Things will not be that big. And so people that have discussed systemic risk, I noticed like this distinction in the book. Some people of them are like, and they are actually more respected before the financial crisis. These are the people that say, oh, there's contagion in financial markets, there's herding, people running all in one direction, and then they have to run in the other one. But even they're not really hurt. Even if it's the IMF that keeps saying this, they're kind of ignored. And then there are the other guys that base themselves on a little older thinking that is the like, financial markets act in booms and busts. Like we're gonna have this like big boom, and then it's like going up, and then woo, you go down. And so this is the other people that keep looking at this, and they keep saying like, look at 2001. We went up, everybody went crazy about .com shares and so on. It's the future. And in the end, what do you get? You get this bust, And that's a little bit what I'm tracing, these people, how are they looking for allies? Because they keep saying this and everybody else keeps saying, no, doesn't matter. What do you talk?
So then how though, okay, so that's the American story and it spread to Europe, but the US always had a very fragmented financial system generally, right? So, and it's very also geographically separate, at least with under banking, right? So, regional banks, credit unions, a lot of it's very decentralized. And we used to have more decentralized capital markets as well. There were stock exchanges in California. It's all kind of changed a lot. But there wasn't that kind of universality. However, in the European context, and I'm thinking of pre-Euro, the German banks had always been universal banks, right? So they, the German pension system was obviously different, and savings were put in banks, but German banks provided insurance services, pension services, capital market services, in as much as Germany had a capital market, but it was less not the same as the US. So I'm curious though, how did that system, how did central banks, or how did the Bundesbank regulate that particular system?
Mhm.
Was it the case that, well, it was a pre-capital, like the capital markets much less less problematic, and is that why it was easier? And in the US case, it was just they're so deep and they're so extensive that it was more complicated. How does that compare?
The Bundesbank, for a long time, they wanted to keep control of the monetary growth aggregates, right? They were looking at credit and they said there's too much credit, so we're going to do something about it. And they still had control. They had this old central bank that is kind of in control. And when they tell the banks we want contraction, they get contraction. But then these banks start to compete globally. So globalization is a big term, but this globalization of banking is really important here because the Deutsche Bank and the other big German banks keep telling the Bundesbank, well, we can't compete.
Right.
If you don't allow us to go into the capital markets and get this capital when we need it, we cannot do what the American banks are doing, and we really want to do it. I mean, you also have to say, like, right, the Deutsche Bank really wanted to do this, and so they go on, they buy, I think, Bankers Trust or something, which is not the very best Wall Street bank they could buy, but they end up buying it, and so they put a lot of pressure. And in 1995, the Bundesbank will give up in the sense, I mean, it's slow, it's a slow retreat. And in 1995, the Bundesbank will say, okay, we can have money market funds and we can have the banks borrowing, interacting with these actors. Because in the end, it's all about this complexification of, like, initially it's only depositors, the bank, and clients, and suddenly it's money market funds, mutual funds, all these kind of actors. And so in 1995, you can really see how this dike breaks in Germany.
And I think this, just to interject there, I think just to make it clear to people that Deutsche Bank and even the Landesbank in Germany, they wanted to compete. And yes, there was the incentive for them to make more money, but actually, which is there, but they were also following German industry, right? Yeah. So it was German industry that was, they were, an internationalizing kind of force. And they were saying to these banks, like, well, we're active in America and we need banking services and capital market services there. And, yes, you've been our house bank in Germany, but then I can go to Citibank down the street and they'll do the services. And so even the Landesbank is saying, oh, wait a minute. And from Baden-Württemberg is like, well, we need to be in New York and we need to be in London offering these services to our existing clients because they're going to leave us there. And so it's kind of this sort of globalization story.
It's a huge wake-up call, I think, when Daimler-Benz registers in New York, everybody in Germany starts to freak out. So that's one element. They're like, whoa, and now they're going to borrow from there. So what are we doing? So that's absolutely correct. And the second part of it is also interesting. He said, for example, for the Landesbanken, they were pushed. But it's an interesting story because the Landesbanken initially had an industrial policy role. That goes out of fashion in the 1980s and 1990s. And then the politicians look at the Landesbanken and they're like, we want more from you. Every year we want more money because that's how we can finance stuff. And so they push them into this. They're like, how can you make more money? And these guys say, well, we can go to Wall Street and play casino. And they're like, yeah, do that. That's great. And you have a little bit the same with the Deutsche Bank because the German state is like, we need at least one international player. So they back them up. There's, of course, I mean, people know that there's a strong relationship between the biggest bank and the state. I mean, you have this I'm sure you have this in the UK also, maybe a little bit less, but you have this in France, you have this in Germany, you have this in many, many countries.
No, I think it's absolutely certain but that I think goes to the naivete to think that any market actor is not is independent of politics. There's always a politics there. I mean, this is a separate kind of conversation, but the Chinese will be very quick to say that, oh, don't criticize us for our relationship with our state-owned banks or state-owned companies because look what you're doing with Goldman Sachs and Deutsche Bank and Daimler and Ford, right? I mean, it's
if they have a problem, you'll save them. So
yes, exactly. So how is it different than what we're doing? And that's not to kind of defend the CCP in China, but they often have a point when they say, like, well, call us state capitalists, but look at you guys. So let's move on to talk about what's happened post 2008 and up to now, because that was a longer period. There was Euro crisis.
Yeah.
COVID came in and I think probably made things a lot worse, but he really showed what that these central banks have a lot of power. And even now, and I think we'll come to that, is now what, right? I mean, inflation all of a sudden came back and it's a huge problem. And then
Yeah. So basically what I tried to show in the book is that these guys have always stood in the corner and that said, look, there's a problem here, maybe we should deal with it. They're actually very influential at the beginning. So in 2007, 2008, when you have what is called the Financial Stability Forum, it's a global body that becomes then the Financial Stability Board, and they are the ones who are basically writing the script of how to interpret what's going on. But basically, they're telling the world, look, there are these fragile financial markets and they're interacting with the banks, and there's this feedback loops, and everything is going down the drain because of that. And in a sense, this also has, of course, very strong regulatory implications, because if you're convinced of that, then basically, probably you should acknowledge the backstop of financial markets, and you should regulate financial markets in a different fashion, because you should say, not only is it about the protection of the individual investor, which is important, I'm not saying that, but it's also about the protection of the system, because you guys, you can take the system down. And so then this is published by Mario Draghi and so on. But if you read these, you're like, wow, this is like really advanced. They're really going out there. But I mean, it's in the midst of the crisis, right? So you can observe this. And then the negotiation starts, right? What should we do about it? And what I show then in the book is there's a strong agreement that something should be done about banking. And so they do something about banking. They're trying to take the banking part a little bit out of this interwovenness with the financial markets, what they call shadow banking. They're trying to draw them out a bit. And so the banks get regulated the most. And it's not a big surprise, because the central banks are in charge of banks. Right. And so because they have to backstop them, they say, hey, we're gonna try to make sure that you become more stable, more resilient. And a lot of what I show in the book is basically that's the big work that has been going on. Yeah, banks become more resilient, stress tests, and many people hopefully have heard about this. And so they stress test them, and then they force them to have more capital. And that works. And then in the second part of the chapter, I show that then the central banks go and say, oh, but now we also have to regulate the financial markets. And in that moment, everybody goes like, oh, do you have evidence for what you're saying? And that's the interesting part. Is like suddenly evidence is necessary. You have to prove beyond a doubt that it's this interaction between the financial markets and the banks that causes all of these problems and so on. And I basically see how, in particular, the market regulators and the accounting regulators say no. No. Not happening. Not happening, not on our watch. And this is leaving this conundrum that I'm showing in the book. The central banks, they know it's very dangerous, it's very fragile, but they have control over the banks, so they do their stuff with the banks, but they don't have the control over the financial market. And so what you see then is, and I mean, this is very interesting, because I trace this for the US, the UK, and Europe, like continental Europe. And you get this big promise that they make to the world, right? The G7 and then the G20 say, never again, we'll protect you, big thing. And we'll put a big name on it. We call it macro, big prudential. So you'll save the financial system. You have all these beautiful sentences that are written, right? But when you then look beyond the rhetoric, you're like, what actually happened? And what you get is a little bit, I don't want to be too negative, so I don't want to have those who listen the feeling that nothing happened. Actually, there was a lot of push on the banks, and they were trying to control their risk taking, but the rest is really what I call a research program. So instead of doing, we're going to regulate these financial markets, it all becomes like, we're going to prove to the world that they are risky. And this is this, and initially, that's not really very much. There's this problem with quantitative easing, and so the central banks, they become forced to enter into quantitative easing because the financial markets don't function as they want. The banks don't lend enough, and so they start to lend all of this out, and they're entering into dangerous territory, which is an irony, which is really an irony, because the central banks, as they try to convince everybody else is like, where's your evidence? You have to show us that they're really risky. And they're like, what? I mean, the house just burned down. Like, what else do we need to? But But when you do quantitative easing, the central banks are like, well, the house has burned down.
Yes.
So we don't need evidence. We're just going to pump and hope, pray, and look, and there's this, yeah, I mean, yeah.
On the securities regulators or the market regulators, was the pushback a bureaucratic one in the sense that this is our territory, this is what we get paid to do, this is not, get out of here, and we're threatened by your mission creep trying to take our stuff? Is it that, or because it could be a both and, was it an intellectual dispute? And then I guess thirdly to that, is it evidence that the market regulators were captured by market actors that had a lot to lose from the intervention of the central bank in that fashion?
No, so you really set this up well, because I can say it's all of those, and even the political, the bureaucratic, and the intellectual. And so what you get immediately after the crisis, even in the US, you actually get a quite strong political push for re-regulation, right? So in particular for money market mutual funds. Because these ones, people may not know, but they broke the buck. So there's a huge run on the money market mutual funds, and people say, that's where the problem came from. We have to regulate these guys.
Yeah.
And so then Obama empowers a lady, if I remember correctly, Marie Shapiro from the SEC, and she goes ahead and she said, we're going to regulate, we're going to treat them like a bank. Because, I mean, there's this American saying, right? If it quacks like a duck, if it walks like a duck, it's a duck. So, and if it behaves like a bank, and if you have a bank run, then maybe you should. Okay. And so she tries to push this through together with the new body that is called the Financial Stability Oversight Council in the US. And then she gets an internal revolt. And that has never happened before. It's absolutely fascinating.
At the Securities and Exchange Commission.
The Securities Exchange Council. So she puts this to regulation, says, we're going to regulate these money market mutual funds like a bank. And then, the SEC is 5 commissioners with her, and 3 oppose.
Right.
In that moment, so 2 of them are Republicans, and we would expect that the Republicans are protecting the free markets, and so to speak. But the third one is a Democrat, and that Democrat is that's where that's a crucial question. Like, why is he acting like that? And he gives a lot of different reasons. The first one is bureaucratic. He says this is mission creep, and the central banks have nothing to do here. Like, keep out. The second one is intellectual. He says we have not developed any own arguments. What you're doing is you're taking the central bankers' arguments and you're imposing it on us. Well, we have economists, and our economists should do this. They should say what we should. Right. And then it's political. Like, he wants to protect the money market funds because the industry is telling him, well, my point of view, the money market funds exist because they are regulated differently from the banks. And if you regulate them like the banks, they will disappear. And that's or become much smaller. And that's what they said. They said, if you do that to us, we are going to be regulated out of existence, and we're so beneficial. And I mean, all the beautiful arguments that you make. And so all of these 3 things play out at the same time, but they were so close to regulating it. And it's not, in the end, I think the political might of the industry should not be underestimated. And so, but she has to step down. The SEC boss has to step down. A new lady comes in and says, okay, we're going to do this our way. We're going to have our economists do this kind of stuff. But then something interesting happens. Economists that think about markets, they didn't know how to do systemic risk. They were like, what is this? They were like, because you may know, they always keep saying, but this is other people's money. And the people who sign up for it, they know that they can lose the money, right? This is the argument, right? And these are professional investors or whatever, and they know what they're doing. And in the end, what you need to get out of this individual level thinking, and you need to go to the system and say, all good and well. But if all of them ask for their money back, then the entire thing comes down. It's like with this game, and when the kids play and they draw out, you draw out a piece of wood, and at some point, and so each individual one might be rational, but the system as a whole comes down. And so they try to impose some regulation, but then we go back to this old game of like, where's your evidence? You don't have evidence. And so
Right.
really not much gets done. They try until, and then they get a little bit done. They get to be able to say, oh, you are systemically important, and so you will come under the umbrella of the central bank, right?
Mhm.
And there's a huge battle over this in 2014-15 in the US. It seems like the central bank and the critical market regulators are winning, and then Donald Trump comes to power, and he undoes everything, like everything. Like it's like in a cartoon when you see these guys that are hammering the things in front of the door, and he's closing this door forever. He's like, never again shall this body designate anybody as a systemically important institution. So basically, he says central banks, there is no way you will get control over these capital markets. And that's so this unhappy consciousness of central bankers, which is like, we know that these guys are risky and we have to backstop, we have to pay the bill, like we have to backstop them, but we can't control them. This Trump is like solidifying. So this is the political element. But, and that's interesting to me, intellectually and bureaucratically, what you can show is, particularly intellectually, that the market regulators, intellectually speaking, they come closer to the central banks. They start to say, oh yeah, there is systemic risk. Oh yeah, now we have the evidence. Oh yeah, now we should do something about it. So this is this development there. And we can go into what happens then during COVID and after, if you want to talk.
So I'm curious, again, because I think this is where what's interesting is that the dilemma is that if you're going to come in and try to be a market liberal and say, let the markets just do their thing, which is often the kind of Republican line, is that regulation is the problem. People are rational. Let the markets do what they do. All fine and well. But then we still have the system, which has a major backstop, and that backstop is the central bank or it's the taxpayer.
Yes.
Right. So say what you will about being, a purist, market liberal, but if you're going to do that, then do it properly. And they never do it properly, right? Because they're always the first that are, looking for a handout when things collapse. And so I'm curious, though, when Trump came in, what was the politics behind that? Who was pushing him to remove that?
Yeah.
And then what happened during COVID?
Yeah. So this is very interesting. So on the one hand, we can already see that the Republicans, still under Obama, they're really strongly opposing any of these moves. And there's this Republican chair of the House Committee on Finance, Jeb Hanseling or something, and he's issuing a cease and desist order. He's like, if you do not stop, I will unfund you.
Yeah.
I will stop you. So you can see that the politics are already there before Trump. Now with Trump coming to power, and this is this is for the American audience, but Trump has a very strong link to a particular segment of the financial market. And we see this now again, right?
Yeah.
And in particular, the hedge fund managers and the hedge fund managers, they felt threatened.
Yeah.
Because in 2016, in the last months of the Obama administration, they set up what they call a working group on hedge funds. And that working group on hedge funds started to collect data.
Yeah.
And they start to do what I show in the book, try to produce the evidence that is necessary to regulate the hedge funds. And the hedge funds, they smell this, they see this, and they go like, we got to stop this. And so by pushing everything back, the hedge funds make sure that they are the last in the line, and they just pushed it, so much further away from them. And that's really fascinating, because when the Democrats come back to power, they're gonna, it's like a coal mine that was closed, and then they come back to power, and then they remove all the wood, and then they open the coal mine again. And today, again, we have a hedge fund working group, and they have proposed regulation. And you have all the hedge funds up in arms against this regulation, against supporting Trump. So there's also a political fight going on that is over the question, for example, how much leverage can a big hedge fund take? And this is where COVID gets super interesting, because these hedge funds, they took not the small ones. And this is very interesting. So if you talk with an industry defender, I mean, they're lobbyists, so they use the metrics in their way, and they will tell you the average hedge fund is leveraged 2.2 times or something like this. It's nothing to see here, no problem. Okay. And then you look at the industry distribution, and you're like, a small hedge fund has a leverage of 1, so borrows €1 for the €1 that they have. Fine. And then you go the distribution further, and you're seeing the really big ones, and they're like 10 or 15. And that's only what is called natural leverage. And then you add the synthetic leverage, which is a bit complicated, but it's basically they're using financial techniques to leverage up even further. And they have a leverage of 1 to 30. So for every euro or dollar that they have borrowed 30.
Right.
And it's like, this is, in a sense, you can see how this is fragile.
Just to kind of add to that, I think, so people understand, when people think of hedge funds, they think of, oh, they're just doing leverage bets on stock market movements in markets, and they are, there's those different particular strategies, but these really large hedge funds, they're also market makers.
Yes.
Right. So they have inserted themselves in the plumbing of the financial system in a systematic fashion. Right. Yes. So it's not that they're just a bunch of smart guys in a room, smart girls and guys and girls that are investing in trying to beat the market and, using leverage to do so. It's like, no, they're actually providing market making functions for the pension funds, other institutional investors, other banks, in a way that, I'm sorry, they're an active part. They're not just sitting there. They're fundamental.
And that is absolutely fascinating development after 2012. Because I said earlier, right, the central banks are trying to push the banks out of it a little bit. And the banks were the big market makers, and they still are partially big market maker, but they put some limits on it through regulation. And as they did that, they were hoping that other guys will come in. There's this big speech by Mark Carney, it's a market in transition, and we'll just backstop it until these market players are there, and then we can go out and it's all fine, and we can go back to the liberal order where the market takes care of itself. The real issue with hedge funds, and you could make the argument that probably maybe also holds for the large broker dealers of banks, but hedge funds are really good weather friends. So they're making the markets when things go well, and they're there. No problem, you can call them up and so on. But when the market doesn't do well, they don't have the heftiness to be still there. They're actually running themselves.
Right.
And that's what happened in 2020. So when COVID hits, and when COVID, they declare the pandemic, many of these hedge funds are caught the wrong way. And you can say, well, who has the full foresight? I mean, who could foresee that this is a global pandemic and so on? And they've made these, and we have to give the reader or the listener a full understanding. It's like they take big bets on what they would consider low risk, right? So they just make a little money, but if you take a lot of borrowed money and you put that in, you make a lot of money. So that's the way that but they're really caught the wrong way, because they thought that interest rates were going to go down, and so they have this bet on the future, and suddenly interest rates go up. And they are like, and they lost a lot of money, because if you only have $1 for every $30 you lose, it's like a magnifying glass, right? So every loss is 30 times bigger. And so they start to sell. And then again, the same thing happens that happened in 2007. And, the system crumbles because somebody starts to run. And then when somebody starts to run, then everybody starts to run, And what happens is the Fed gets these phone calls from the market in New York, where people are calling and they're saying, this is getting crazy, And here's something happens that we haven't talked a lot enough about. And this is what I really want to bring to the public, So in 2020, what happens is that they're big banks, broker dealers, they have lent a few $100 billion to these hedge funds. And they make this phone call to the Fed and they say, look, these hedge funds are about to sell. When these hedge funds sell, they will make huge losses. If they make huge losses, we don't get paid back. If we don't get paid back, we're the large banks. So we have a suggestion for you. And that suggestion gets implemented. That suggestion is, why don't you buy up these treasury bonds that are causing all these losses, and you buy them up on the market, not on the market value, but on par, like what they are officially worth. So you make everyone whole. You make everyone whole in the system, and you take these risks on your balance sheet.
Mm-hmm.
And that's exactly what happened. So in March 2020, when everybody's focusing on COVID, which is rightly so, the Fed goes into the market and buys a few $100 billion from these broker dealers and from these hedge funds to prevent a financial crisis. And after that, they will not really talk about it because nothing happened, right? Because there is no financial crisis. But what's your problem? There's nothing happened. It's just a few $100 billion that are on our balance sheet now. But everything else, and this is what I mean, is this what I call this unhappy consciousness. You're watching a system that can inflagrate immediately, and so you're looking for the smallest spark, and you're like, before that really gets big, you're going in.
Right.
And you can't change the system, and this is the problem. I think this is really the problem.
And half these people are even more probably think of themselves as market liberals, and
definitely.
Everybody that wants to regulate is a communist, and like just let capitalism do what it wants to do. Yet, mommy, I can't make money. Like, bail me out.
And the system will go down. I mean, this is the thing. I mean, if they would just say, mommy, I can make money, the answer would be, well,
you made it wrong. You bet on the wrong horse.
Yes,
right?
and you're with the wrong guy. I'm not your mommy. And it's funny because the Fed New York guys, when you talk with them, many of them are also market liberals.
Yeah.
But then what really strikes home is this systemic risk notion. And I'm not saying it's wrong, because the fact of the matter is, if the Fed had not intervened, we would have had a major financial crisis.
Right.
But the problem is that we're staying in a system where this stays always a latent possibility.
Yes.
And so the central banks always have to step in. And this is where I'm like, no, this can't stay like this. It shouldn't stay.
No. It's a major. Okay, so then that's the moral hazard is there, and people talked about the moral hazard.
Yeah.
Meaning that, basically there's no disincentive from taking risk because you'll always be bailed out.
Yes.
How do we unravel that, right? How do we get back to, I'm going to channel some Adam Smith, like or a particular view of Adam Smith, right? Where he wasn't anti-regulation per se at all, but in the sense of, let's get rid of these distortions, because they're problematic. They create
I did an interview with a very very good economist, and he was before the Fed, and then he was at a major business school in the US, and he told me these asset fund managers, they're all on risk. They're all on risk after the financial crisis and after COVID in particular, because they know there is a backstop. They know that if things go wrong, they'll be bailed out. So it's a real problem. And the way that the Fed and the allies now try to deal with this, and I'm talking about Janet Yellen and Gary Gensler and so on, they were like, let's try to put some limits on leverage of these hedge funds, because this is what is causing the problem. If they're small and they lose their own money, let them lose their money. That's capitalism. Let them lose their money. But because they're so huge, they've become too big to fail again. They're not the banks now, they're the hedge funds, but they've become too big to fail. And so you really need to say, okay, the big banks, stop lending to the broker, stop lending to the hedge funds. Even that's how you would make good money. Stop it. You need to say to the hedge funds, stop being so leveraged, but because you're causing a systemic problem. So to take the systemic part of them into account. And what is fascinating about them is that they always deny this. They're like, we're not systemic. How do you know? You don't have any data on us. But then when you're like, I want the data on you, they're like, no, we can't give you the data, because then everybody will know what we're doing and we lose our information advantage. We can't make money anymore. And then and this is where the politics of this lies. The fascinating thing is the politics lies in these battles that 99.9% of the population don't know about. But these battles decide in the end that when the financial crisis comes, the central bank has to step in and is going to bail out the richest 1%. I think this is where we are like, that's not right. But for me, those who follow this, the SEC tried to say, we're going to collect information on hedge funds, they made a rule. And I was very amazed by that, because this means taking on a very powerful industry. And these guys then come back. Now the appeal court, the fifth appeal court in Florida, ruled that the SEC overstepped their mandate, because these are professional investors and you don't need to regulate them like, a mom and pop shop.
Yeah.
And you're like, and I was expecting this to happen when Trump is in power, if Trump comes to power. But this happened under Biden, because, and then I had a friend of mine look into it, and who's sitting on the appeal court? Guys from Reagan, because they're very long living.
Yeah.
Guys from Bush, guys from Trump, and a few, but the majority of that court is Republicans that are driving this. And you're like, the power of high finance, of hedge funds, is so entrenched in the US that even when these technocrats, they have the right arguments, they have the data, because they collected the data during COVID. They built, after the financial crisis, everybody kept saying, you don't have data. So what did they do? They build up all these cameras. It's like you're trying to observe the fauna in the real life, right? And so they just build up the camera, and then COVID happens, and they catch it all on camera, and they're like, well, but the industry says, what's your problem? There was no financial crisis. And then the Fed says, but wait, there was no financial crisis because we saved you. And these guys say, are you sure? We don't know. But you should have just let this run its way. If you had just let it run its way, then everything would have been fine. How do you know that there would have been a financial? And you're like, this feels so wrong,
Yeah. But is it so much of a Democrats versus Republican issue, in the sense that, how many hundreds of thousands of dollars does Obama get for every speech that he gives? Who's he giving speeches to? Clinton, both Clintons. I mean, you look at how bought and paid for the Democratic Party is by Wall Street and Silicon Valley, which Trump plays to his advantage. But it's kind of, I mean, you can look at these courts and you can say it's Reagan, it's this, but the Democrats really aren't that much better, are they? Or
it's very interesting, because we can then enter into there should be work on this. So on the one hand, maybe we can distinguish different factions of financial. And so there's very good work that was done on this in the UK, and these researchers, Monsieur Theo Bourgeron and Marlène Blanquet, they promised they would do it on the US, but I haven't seen the data yet. But they show for Brexit that the Brexiteers, they were funded by the hedge funds, because they wanted, they wanted the cows, and they wanted no regulation. They needed that, and the big banks and the insurance industry, they were giving their money to the no Brexit guys.
Right.
And I have the feeling that you have a similar, and we saw this with Mercer. For Trump in 2016, Mercer is a big hedge fund guy, and he backed up Trump, and he gave him Cambridge Analytica, and he gave him the money, and he gave him the data. So you can clearly identify an alliance between a certain segment of financial capital and Trump. Now, I don't want to speak for the Republican Party as a whole. I'm not an Americanist. I don't know enough about America to make that case. But for me, the last thing that I really found interesting was, because I was watching this, Gary Gensler at the SEC, Janet Yellen at the Treasury, and now is Jay Powell, who's a Republican, and he was at the Fed. But these guys are collaborating to get control over this fragile non-banking system, and they are mostly Democrats, and they're pushing it. So there is this alliance, in a sense, of a certain wing of the Democrats. I think we can have a long conversation about this, because the real there's also a state project here. You spoke earlier about state capitalism. The US, everybody understands that they are on course to borrow a lot of money, and to be able to borrow a lot of money, you need a very stable treasury market. You need one that is the most liquid, well behaved, cheap, so everybody's happy. And what happened in 2020 was that when the hedge funds withdrew, suddenly you got this market going like, and everybody was like, what's going on with the treasury market, And so there's also this element of these guys saying, we need to borrow a lot of money, so we need to make this infrastructure stable.
Right.
And so there's also the state project beyond the politics of it. There are technocrats that are saying, as we have to borrow, we have to make sure that these borrowing costs are not spiraling out of control. And so that's where I see these vectors coming together to go into this. But I don't know if Trump is responsible enough, if he came to power, to see this.
Well, I guess then it falls on Congress, right? Because Congress effectively is who has to decide on public spending, and left, right, center, they all like to like to spend. And the debt dynamics of the United States is, debt servicing costs are only going to increase with aging. I mean, you can hope that, the U.S. has good growth now, but is it going to be so big that it can counteract some of these debt dynamics? And I don't think that's the case. I mean, the U.S. is in a much better position than the U.K. And probably most of Europe, for that matter, in terms of worrying about. But so I guess the point then is that you think, because of, is it that Congress will have to come in and really regulate it to create that stability? That's eventually what could happen.
They're the absent actor here in the room. Like, they should be in the room, and they should do regulation. They should do laws, actually.
Yeah.
So
Congress does nothing most of the time.
Unfortunately, and but it's also a story of 50 years and what industry does very often. So every time they were about to regulate the money market mutual fund industry, these guys said, look, we're $1 trillion, we're $2 trillion, we're $4 trillion. Like, we're this huge thing. And if you regulate us, there's going to be huge chaos. And that's their argument. That's like the normative power of the factual. We're just there, and you can't get rid of us. And that is, but you kind of need to at least to channel it. And what central banks, the guys that I'm showing in this book, they've been running around for 40 years saying, at least, give us the right to constrain these guys, because we have to backstop them, and they're not getting it. And whenever they try, then Congress comes in, the president comes, Trump comes in or whatever, and stops them. But as responsible, in a sense, as responsible technocrats, they can't say, okay, then I'm going to let the thing go down the drain because I didn't get my will. So I'm going to, just let this play out. It's this, it's people are really afraid after 2008, right? I mean, in the end, 2008 was this moment when Bernanke and Paulson said, I'm not going to take the political heat and I'm going to let this go down. And that's it. Yeah. And then you had the systemic implications of it and everything. Everybody was like, no, from now on, we bail out,
So then I guess just to kind of switch gears slightly, I've got two final questions before we end. The first being, on the left, there's been quite a bit of discussion. I mean, there's the MMT crowd, the modern monetary theory crowd, that says, well, just keep printing. It's not a big deal. I don't want to get into that because I think that kind of is too technical. But then there are increasing voices or debates around central banks should be mobilized to finance the green transition. Wow. I'm curious what you think about that. And given what you've said about the incapacity of the central bank, the Fed in the US, but for that matter, the Bank of England or the European Central Bank, I mean, to really get a grasp of the existing basic financial system that exists, is there any scope for central banks to kind of go in and start spending and doing these things or is that just, to me, it just seems like an intellectual project about this is what central banks could do, but that's never going to happen.
No, this is very interesting. And I think because, I mean, it does, in a sense, violate a certain understanding of what central banks should do and how they should do it. And so I first want to ask, where and when did this come up? Because you can ask yourself also about the historical reasons why now people are asking this, besides the fact, of course, that the climate crisis is very urgent and it demands action. So people are like, something has to be done. So the first thing is, central banks today hold up to 20% of financial assets in the West. And when you do that, you have a very hard time saying, "Oh, I'm just a bystander." I'm just a marginal player doing a little. No, you are the 1,000-ton gorilla. Yeah, I mean,
you're bigger than BlackRock.
Yeah, you're like
basically.
very strong. So
Yeah.
so then I think it's in a sense kind of normal for people to say, well, if you can do that, and if you can stay, then you can also do that. So first
Yeah.
of all, to get an understanding of where this comes from, I think, and that's important. Second thing is, if we look at it, and we haven't much spoken about this, but people should also be aware that all these thousands of billions of assets on central banks' balance sheets, they're currently causing a lot of losses. Which the question is, does somebody have to pay it or not? But I can tell you, the Fed and the European system of central banks and the Bank of England will send a demand to their Congress and Parliament soon. Basically, by the end of this year, we know that they've used up in Europe all the buffers.
Right.
So this year, all the losses will have to somebody. So that will also change the dynamics a little bit, I think. And so then, but lastly, to answer your question on green. So you may know Eric Monet has this big intervention, and Eric Monet's intervention is to say, let's have a credit council that speaks to the ECB and says, how can we do these things? Then the ECB itself has said, and the ECB is much more advanced on this than the Bank of England or the Fed for evident political reasons.
Yeah.
So they've said, well, we can do a credit register, and then so we can give, when we have a credit register, we can give some preferential credit. And so for people to understand, basically, for this to work, the idea is the central bank will give a lower preferential interest rate to those projects that are linked to green, so solar, wind, and so on. And for that, you need a credit register that says, well, this is a loan that is going to build a windmill or whatever.
Yeah.
And so but as a comparison for people to know, the Chinese are already doing it. They have exactly that. For 3 years, the People's Bank of China gives now preferential credit for clearly identified green projects. Now, I think, from my perspective, I think we have development banks for that in Europe. And I think what we should maybe talk about, what we could talk about, is maybe there's a way of the European Central Bank to more support these development banks, and then these development banks, they can do it. So rather than having directly the ECB involved. So, but I mean, I think we have to ask quite a lot of questions about. People know that with high interest rates, the financing of windmills and solar becomes problematic.
Yeah.
And we're in an era we're in an era of very tough geopolitical tensions. And the more you can be independent of
Russia,
for example, the better that is. And so there is, I think there is a legitimate debate where we should ask ourselves, maybe what is the best way of doing this? And I'm also studying development banks, and I find them actually they're doing this for 20 years, and the European Investment Bank and others, they have developed this capacity. So maybe it's just enough to wink to the market and be like, we'll support the European Investment Bank. We, the ECB, we will always support the European Investment Bank as they expand, and in this way to solve it. But I think in general, I would not be generally against it, because I personally think better. I mean, we need solar and wind. That's my position.
Right. Okay. Well, I think that's something. I mean, we need another hour to talk about the development banks, and I know you and I have discussed offline previously, and workshops and the like around on development banking and sovereign funds in this particular space, and the role of the state increasingly in addressing a lot of things. Right. Where again, where are the market actors? And unfortunately, with a lot of this, but often it just comes down to the cost of capital, and how can we reduce the cost of capital to do things that are beneficial. And again, there's always a politics, right? I think whether it's a public sector or a state-based body, or it's the private sector, as we've just been discussing around hedge funds, there's always a politics in there. But I think this has been very useful and I don't think our conversation has been too technical on central banking. Some people probably stopped listening halfway through, but those that continued, hopefully you've gained something. But there's so much politics, and I think if we had more time, we could talk about what the outcomes mean for November. Europe is going rightward, and the populists they want to stay. They're, even more kind of socialist than people recognize, but in a different way for
Yeah.
specific populations, though.
Yeah. Yeah.
Right.
I have this before. I have this
And
before.
so, we could be shifting back to some other kind of era in central banking and financial regulation that maybe brings some of the interesting parts of the left with the populist right in a way where no one can figure out what the spectrum of politics is.
Yes.
On that note, Matthias, I think your book is excellent. Yes, it's an academic book. There it is, Taming the Cycles of Finance. So it's an academic book, but if you really want to get into macroprudential regulation and you don't want to just, you see the bigger story and narrative, I think it provides that basis for people to delve deeper. We'll put it in the show notes, and hopefully this won't be the last time I have you on the New Enlightenment podcast. I'll have you to Panmure House at some point for sure, because this topic needs to be debated, and then the role of central banks is fundamental to how we understand capitalism and the sustainability transition.
Absolutely.
So on that note, Matthias, thank you very much for being on the New Enlightenment, and hope to see you again soon.
Thank you very much.
You have been listening to the New Enlightenment podcast from Adam Smith's Panmure House. If you found this interesting, please consider subscribing and sharing. If you would like to learn more about Panmure House, please go to our website, panmurehouse.org. Thanks for listening, and until next time.